you see massive accumulation of gold and silver off the exchanges taking possession. So let's put all of this together, right? So what does it all mean when put together? And let's think about the Great Reset. How do you get a Great Reset? Well, first, you blow up asset prices to all-time highs at the lowest interest rates in human history. And then you incentivize the world to find a backdoor because you watch what just happened to the Russians, who 85% of the world is saying, well, you're still okay to trade with because they don't like the way the West has handled things.
Andy Schectman explains that there's a massive global accumulation of gold and silver, particularly by central banks, sovereign nations, and wealthy investors who are taking physical possession rather than relying on paper contracts or ETFs. This trend, he says, reflects a growing loss of trust in the Western financial system and a shift toward tangible, real assets that hold intrinsic value. He connects this phenomenon to the broader concept of a Great Reset, a systemic financial reorganization that often follows the artificial inflation of asset prices. According to Schectman, this reset process starts when central banks and governments inflate asset values to historic highs by maintaining ultra-low interest rates and flooding markets with liquidity. This creates an illusion of wealth and stability, but in reality, it builds massive bubbles across equities, bonds, and real estate. When those bubbles begin to deflate, the imbalance in the system becomes clear, forcing nations and investors to seek alternatives to the U.S. dollar-dominated system. Schectman points to how Russia's experience, being cut off from Western financial systems and having its reserves frozen, has sent a clear warning to other countries. Roughly 85% of the world, according to him, now views the Western model as untrustworthy and is seeking new ways to conduct trade and store wealth outside the Western financial structure. This discontent has led to growing alliances among countries, particularly those involved in the Belt and Road Initiative BRI, a network now encompassing 147 nations. These nations are increasingly trading in their own currencies, accumulating gold and silver, and establishing mechanisms to settle trade without relying on the U.S. dollar or Western banks. Schectman interprets all of this as a strategic realignment of global power, a quiet but powerful movement away from the dollar-based financial order toward a multipolar system backed by real assets. The accumulation of precious metals, he suggests, is not random. It is a calculated move to prepare for a reset where gold and silver will reassert their roles as foundational stores of value in a restructured global economy.
So they're all coalescing in this nation, 147 countries on the Belt Road. All of these countries in the BRICS nations, which amount to 90% of human population, all of this together. And think of the fallacy of composition. All of these countries, one by one, can't stand up to the U.S. You put them all together and they will dominate the U.S. So how does it all blow up? Why do you own gold and silver? Why? Remember, gold was classified the only tier one asset in the world next to U.S. dollars. Remember, the biggest money in the world, the central banks, the commercial banks, the sovereign wealth funds, the family offices, they're all buying it. They're all taking it off the exchanges, removing counterparty risk. You can see the drawdown from all of the major exchanges. How does this all blow up? Simple. Saudi Arabia joins the BRICS nations, and Saudi Arabia says, hey, U.S., thank you. It's been a hell of a ride. We appreciate it. As you know, we are being now protected by China and Russia. In fact, we struck a joint military cooperation agreement the day you pulled out of Afghanistan. You know what? It's in our best interest, and all of OPEC, who is on the Belt Road, that we're going to open up energy purchases in other currencies, including the yuan, the rupee, the ruble, maybe euro, gold, and dollars. Like that, it's over. Because what happens? Every country on the planet who has had to own dollars since 1974 dumps them, because everyone will start dumping dollars. As the dollar collapses, that's pillar number one. The dollar value collapses. What happens when those dollars collapse and hit the U.S. shores? Hyperinflation. What happens as an adverse reaction of hyperinflation? Interest rates spike. You have to have higher interest rates to compensate for the loss of purchasing power. When everyone dumps dollars and Saudi Arabia and OPEC say, thanks for the memories, folks, and everyone dumps dollars and interest rates spike, stocks, bonds, real estate at the same time collapse along with the dollar. The four pillars of wealth in this country, stocks, bonds, dollars, and real estate, will all collapse as interest rates spike and as the dollar is globally dumped. And this is your great reset. This is how fragile the system truly is. And this is why you own precious metals. It is not to get rich, it's because we are on the cusp, I believe, of a change. Now, one last piece that I'd like to add to it. 75% of human population understanding on the Belt Road this new digital yuan. Well, what is the digital yuan? To me, it is a beta test. Just the other day, there was an article that came out by a man named Sergei Glazyev, and he is the Russian minister in charge of integration and macroeconomics for the Eurasian Economic Union. And he came out and he laid the fundamental principles by which the new U.S. post-dollar economic system will be based. And he goes on and says, and I quote, that it will not be based upon any particular currency as with the Bretton Woods order, but rather a market basket of local currencies tied more deeply to an array of real commodities such as gold, other precious metals, grain, hydrocarbons, sugar, etc.
Andy Schectman warns that the global financial order is shifting away from U.S. dominance as BRICS nations, representing most of the world's population, unite economically and militarily. He explains that individually these nations can't challenge the U.S., but together they can overpower it. The tipping point, he says, will come when Saudi Arabia formally joins BRICS and begins selling oil in currencies other than the U.S. dollar. Once OPEC members follow, countries worldwide will dump their dollar reserves, triggering a collapse in the dollar's value. This will lead to hyperinflation in the U.S., spiking interest rates, and a simultaneous crash in stocks, bonds, real estate, and the dollar itself. The four pillars of American wealth, ushering in what he calls a great reset. Schectman argues this is why central banks and major financial entities are rapidly buying and removing gold from exchanges to eliminate counterparty risk and prepare for a post-dollar world. He cites Russian economist Sergei Glazyev's proposal for a new BRICS-led economic system based not on a single currency, but on a basket of local currencies tied to real commodities like gold, oil, and grain, backed by blockchain transparency. He concludes that gold's Tier 1 status and the rise of the digital yuan show that the world is moving toward a commodity-backed monetary order, making precious metals essential not for profit, but for protection against systemic collapse.
So think about the Chinese digital yuan. What better way to roll out a distributed ledger technology where you can show the world the veracity of everything that all of these countries have pegged? Why does the European Union not work? In theory, because there's nothing pegged to it, and each country is moving in different directions. But how about all of these countries coalescing not only against the universal dislike of the Western hegemony, so much so that we're seeing relationships being mended between Iraq and Iran, where they're building a railway between Iran and Saudi Arabia. They're mending fences between countries who have hated each other for years. But you know the old statement, my enemy's enemy is my friend. They are all coalescing against a central theme. But that's not enough. We need to peg something. What are all the countries that own all the commodities? The BRICS. And all of the countries that are joining the BRICS own all the commodities. So what better way to roll out distributed ledger technology, but to show the pegging of all of the commodities pledged to the new BRICS currency, which they just announced is coming out. Why is gold Tier 1? You tell me. Did they know that this was going to happen? The inevitability and the mathematics of the dollar's demise? Is it going to be the central peg to a new world reserve currency? What better way to show the immutability and the veracity of this pegging, but on a distributed ledger, Chinese digital yuan, which I believe will be the rails to a new system, the rails to the new BRICS system, to the BRICS currency. And when that happens, God help us in this country. The reclassification of gold Tier 1 is huge. You know, just to touch on that for 1 second, everyone in my industry always thought that if anything ever rose to the level of dollar prominence, it would be something like a special drawing rights from the IMF. Maybe it makes a little more sense why the central banks are accumulating and taking possession of the gold because of its riskless elevated Tier 1 status. So anyways, the dollar was backed by gold as far as governments were concerned. We promise that any of the gold that we're holding for you, you can exchange your dollars, or even just the dollars that you own. You can exchange them for gold at a fixed rate of $35 whenever you want. Towards the end of the Vietnam War, President de Gaulle from France realized that we were issuing more dollars and treasuries to fund the war than we had gold backing these promises. So he sent warships filled with dollars to New York Harbor and said to, President Nixon, we want our gold back for these dollars. And we gave it to him. And he bled down a very large portion of the gold held at the U.S. Treasury. And at that moment, Nixon said, okay, August of 1971, that's it. The window's closed temporarily, although it's never opened back up. But we went back on our promise to the world. And it was at that moment that the dollar was backed by nothing. And so the question that I ask the people out there, and it's amazing how few people know the answer to this question, is what has made the dollar the world reserve currency ever since? And you get a myriad of answers, usually centered around our military, or we have the biggest and most robust economy, or whatever. And I guess you could argue some of that is true. But what has made the dollar the world reserve currency was that 3 years later, Henry Kissinger was dispatched to Saudi Arabia. And he made a promise to the Saudis. He said, how about this? We will back you. Well, let's call it a joint military cooperation agreement. And we will stand behind you. We'll provide you munitions and support. No one will ever mess with the Saudi kingdom. But for that, OPEC is going to value oil in dollars globally. Okay, they said, fine. And so since 1974, every single country on the planet has had to own, virtually every country has had to own dollars in order to buy oil. And it has created this synthetic demand for the dollar called the petrodollar and made the dollar the world reserve currency. If you want to power your country, you must own dollars. It is the protection of the Saudi kingdom and by default, the relationship with OPEC that has enabled the dollar to be the world reserve since 1974, because 3 years prior, the link to gold was severed. The dollar was at that point fiat, backed by nothing. And obviously, we all know the history. Since that point, the dollar's lost over 90% of its value.
Andy Schectman explains the historical and geopolitical underpinnings of the U.S. dollar status as a world reserve currency and how global monetary dynamics may be shifting. He highlights that the dollar's dominance was never purely due to economic strength or military power, but largely because of the petrodollar system established in the 1970s. After the U.S. ended the gold standard in 1971, the dollar became fiat currency, backed by nothing tangible. A few years later, Henry Kissinger negotiated with Saudi Arabia, promising military protection in exchange for OPEC pricing oil exclusively in dollars. This created synthetic global demand for dollars, cementing its reserve status. Schectman also touches on potential rise of a new global currency system, possibly tied to gold and operated through digital technologies like the Chinese digital yuan on distributed ledgers, which could serve as a foundation for the BRICS currency. He notes that central banks' gold accumulation reflects its riskless Tier 1 status, hinting at how the global monetary order might shift away from the dollar in the future, with significant implications for the U.S. Essentially, he connects historical policy decisions, the end of the gold standard, and modern digital currency developments to explain both the dollar's rise and the potential challenges it now faces.